Good morning, my splurging virgins. Let's talk about GDP, jobs, and inflation. Yeah, I know it sounds boring, and trust me, I was bored just saying that sentence like an Econ 101 lecture taught by Ben Stein in slow motion. But trust me, when the Fed and the markets are hanging on these numbers like it's the Super Bowl, you're going to want to pay attention here. Pay attention, all right? Because this is an econ class. This is your portfolio, your mortgage, and whether you're going to be eating steak or ramen next month. So let's make like some butt cheeks and dive straight into these three things. So here's the big headline: jobless claims fell by 5,000. What? To 229,000. Yes, fewer layoffs, but hold the champagne because hiring sucks. We're adding like 35,000 jobs a month. That's not a labor market. That's a high school summer job program. It's this weird no hire, no fire economy. Companies aren't laying off, but they're also not bringing in new people. It's like when you're in a dead relationship, you're not breaking up, but you're definitely not going on dates anymore. That's for sure. So things are just a wee bit awkward, right? So, yeah. And thanks to Trump's immigration crackdown, the labor pool is shrinking. So unemployment might only tick up to 4.3% in August, even though nobody's actually hiring. That's like saying the Titanic isn't sinking because technically you haven't hit the iceberg yet. So here's why the markets care. The Fed's watching this like a hawk. Jerome Powell basically admitted last week, hey, we might have to cut rates because this job market is looking shakier than Rudy Giuliani's hair dye. But here's the catch: inflation is still too high. So Powell is in the worst possible spot. If he cuts rates, inflation could stick. If he doesn't cut, jobs could crater faster than cheap underwear from Walmart. Uh, and this is the central bank's version of picking between Trump and Biden because, well, nobody wins in this. Now, let's talk GDP. The US economy grew to 3.3% last quarter, and that sounds great, right? Well, not too fast. Why did it look so good? Imports collapsed 30% because of tariffs. Yeah, when you stop buying stuff from other country, it makes your GDP look better on paper. That's not economic strength. That's like losing 20 pounds by cutting off your leg. Consumer spending ticked up to 1.6%, which is still better than last quarter, but still, who really cares? And private investment is down nearly 14%. Businesses are basically saying right now, we don't know what the hell Trump is going to tariff next. So we're just sitting on our wallets. So yeah, we grew, but it's like saying your kid got an A after you spotted them the answers. So just keep that in mind. Now let's get to tomorrow's main event, the PCE report, because that's what you're all here for. This is the Fed's favorite inflation gauge, and right now it's hotter than a Kardashian prenup, woohoo, or an Anthony Edwards child support payment that covers you for the child's 18 years. Economists expect overall PCE at 2.6% year over year, same as June. But core PCE, the one that strips out food and energy, is expected to tick up to 2.9%. And that is not good. Remember, the Fed's target is 2%. We haven't been under target in over 4 years. Powell's probably looking at this report like, do I really want my last act as Fed chair to be screwing this up? Or is he just going to hike rates? That would be like the funniest thing ever. But anyways, let's talk about our scenarios like we always do. Scenario 1, PCE cools off. Let's say we get a surprise drop. Maybe core PCE backs down to 2.7% or lower. Markets will throw a party. Hey, yeah. We're talking SPY, ripping, QQ mooning, and every trader on X posting rocket emojis like it's 2021 all over again. This makes a September rate cut basically a lock. Scenario 2, we got PCE stays flat at 2.9%. Yeah, we're talking flat. like 2 CD cases in your back pants. Nothing back there, baby. More likely, it's sticky. Tariffs are pushing up goods prices right now. Services are climbing too. Healthcare, shelter, airfare. If that's the case, well, the Fed still might cut, but it's gonna be with one eye open like this. Um, think of it like sneaking into the fridge at midnight. You're doing it, but you're praying nobody notices or you miss that one squeaky floorboard that's going to wake up the whole house. Now, third and final scenario. PCE surprises higher, 3% or more. This is the nightmare. If inflation ticks up past 3%, the gloves come off, all bets are off, do the DNA test, sign that prenup, and don't text your ex. The markets will tank. Rate cut odds collapse, and Powell's going to look like the guy who brought a kazoo to a funeral. Not a great look. Traders are already pricing in an 88% chance of a September cut. So if that gets nuked, you'll see panic selling faster than a Tesla Cybertruck recall. So here's the bottom line today. Jobless claims are telling us the labor market's weakening. GDP is telling us the economy's technically growing, but in the dumbest possible way. And tomorrow's PCE, that's the tiebreaker. This is Powell's nightmare. Inflation too high, jobs too weak, and Trump breathing down his neck tweeting, cut rates or you're fired. Cut rates or you're fired. Because that dude loves firing people, apparently. Welcome to America, where the economy is always one headline away from either a boom or a full-blown dumpster fire. And not even a headline, sometimes a tweet away, which is even scarier. All right, degenerates and virgins, that's your 10-minute crash course on jobs, GDP, and tomorrow's inflation showdown. Make sure to abuse that like button, drop your PCE prediction in the comments, bullish, bearish, or just buying tequila. And I'll see you losers tomorrow for Fast Money Fridays when we find out if Powell's pulling the trigger or just sweating bullets in his bad shirts. All right, I'll see you guys in the next one.